Hi everyone, this is Kevin Zhao. In this chapter, you will learn how to calculate the bond price, understand the various measures of bond yields, and explore the inverse relation between bond price and the interest rate. The interest rate is one of the most important factors that shape bond prices. Let's review some basic aspects of the interest rate. Simply put, the interest rate is the price of money. If you wanted to borrow money, then the price you need to pay is the interest. The magnitude of interest rates have something to do with the time length and the risk involving the borrowing. For instance, 30-year T-bond rate is higher than 10-year T-note rate because it's longer maturity. The interest rate on AAA rated corporate bond is lower than the CCC rated bond because it involves much lower default risk. A specific interest rate consists of three components: the risk-free rate, expected inflation rate, and risk premium. The term structure of the interest rate describes the relation between the interest rate and the term to maturity. The graphic expression of this relation is called a yield curve. Yield curve may be upward sloping, downward sloping, flat, or zigzag. Several theories have been developed to explain the shapes of a yield curve. Among those theories, the most popular one is the pure expectation theory, which states that the shape of the yield curve reflects investors' expectations on future interest rate movement. An upward or downward sloping curve indicates that the interest rate is going to go up or decline in the near future. Other theories include liquidity theory, investor preferences theory. The yield spread is the difference in interest rates due to the difference in bond credit rating. For example, the interest rate for AAA and the AA rated bonds are 5% and 7% respectively. The yield spread between those two bonds is 7 minus 5% equals 2%. The reason why AA bond earn 2% higher interest rate than AAA bond is that AA bond is riskier than AAA bond, and the 2% actual return is compensated for actual risk bearing. Therefore, the yield spread can also be as risk premium. In the past, when economy is getting worse, the yield spread tends to get higher, and when economy is getting better, the yield spread shrinks. The yield spread is often used by investors to predict stock market trend. There are several measures associated with the bond yield. The first one is coupon rate. The second one is current yield. The coupon rate is the stated rate in the bond contract, and the current yield equals coupon divided by bond price. The coupon rate has nothing to do with the bond yield. The current yield is an okay but not a great measure of bond yield. Then, what is the best measure for bond yield? The yield to maturity is. The yield to maturity, or YTM, is the discount rate that equalizes bond price and its present values of both coupons and the principal payments in a bond. These slides show the mathematical process of solving yield to maturity. You may use a financial calculator to find the yield to maturity in a much easier manner. For callable bond, yield to maturity is calculated in a different fashion. The realized yield is a yield based on reinvesting coupons at various rates. Note that yield to maturity assumes coupons reinvested in the rate of yield to maturity. Bond total return has three components: coupon, capital gains, and interest on reinvested coupons. Reinvestment risk is risk that investor may earn lower returns on the interest on coupon due to future declining interest rates. Longer-term bond has higher reinvestment risk because there will be more coupons to be reinvested. Zero coupon bond has no reinvestment risk because there will be no coupons to receive. Now, let's move to calculate the bond price. In principle, any security price should equal to its present values of future cash flows. For bonds, the price equals present values of both coupons and the principals of face value. The intrinsic value of any security should be determined by, first, expected cash flows, second, timing of cash flows, and third, the discount rate. This equation shows how to calculate the price of bond with a coupon paid semi-annually. In the equation, P is the bond price, C is the annual coupon payments, and FV is the face value. The R is the discount rate. Excuse me. The key of bond pricing is determination of discount rate, which involves consideration of maturity and default risk. The fundamental mechanism of bond pricing is the inverse relation between bond price and the interest rate. When interest rate increases, bond price will fall because the higher discount rate will depress present values as well as bond prices. Suppose that U.S. Federal Reserve is going to raise the interest rate. It will be a bad news for bond investors because bond price will go south. By the same token, cutting interest rates by the Federal Reserve will be an exciting news for bond investors. This graph shows the path of bond price for premium and discount bonds. Over time, premium bond price will fall and converge to its face value, while the discount bond price will increase and converge to its face value. This graph once again shows the inverse relation between the bond price and the interest rate or bond yield. Remember, higher interest rate is bad news and a low interest rate is a good news. The interest rate risk is risk that investors may lose money due to higher interest rates. Interest rate risk is greater for long-term bonds and for bonds with low coupon rates. So when interest rate is declining, investors should seek bonds with longer terms to maturity and a low coupon rate to maximize gains. When interest rates are increasing, investors should minimize the interest rate risk by investing in short-term bonds with higher coupon rate. This is Kevin Zhao. I hope you enjoyed today's video, and I will see you in next class.